This episode of the Commercial Real Estate Investor Podcast is brought to you by Hamilton, a value-add investment and development firm in Nashville, Tennessee, focused on bringing passive real estate investment opportunities directly to your inbox. Visit www.investwithhamilton.com/invest to sign up for upcoming investment opportunities. Welcome back to the Commercial Real Estate Investor Podcast. My name is Tyler Cobble, your host as always, and excited to dive into today's conversation with Jesse Fragale. He is a commercial real estate broker based in the greater Toronto area. We actually met through Bigger Pockets. He was on stage with me last year talking about commercial real estate. So excited to finally get you on the show, man. Jesse is also host of the Working Capital Real Estate Podcast, and he's a wealth of knowledge when it comes to the real estate market and what's going on, especially on the office and multifamily side. So, Jesse, I know that's a very brief introduction of who you are. Tell us a little bit more about you.
Yeah, for sure. Well, thanks for having me on, Tyler. It was a pleasure being on stage. On stage last time we were out there. But yeah, for those that would like to know, I got started in the investing side of the business, and then later joined the commercial brokerage side, which I find for a lot of people, even on my podcast, it's usually the other way around if those things kind of intersect. But yeah, I mean, for me, I started investing in student rentals just over 10 years ago. That's where I kind of got my start. I think it's a great business where you can buy relatively smaller deals, but kind of deal with multifamily problems. So it's probably a good learning curve, but probably not the best long-term thing unless you have your systems in place. But then from there, I continued to kind of grow the portfolio. Refinanced, bought here and there single family housing, condos. Anybody from Toronto is well aware we have a huge condo market. So kind of did some assignments on that side, and then eventually started buying multifamily. And that's kind of been the focus the last little while for the investing side of things. So yeah, it's been exciting. I think, like you said before, I think there's a lot to talk about these days. And yeah, I'm excited to be on.
Yeah, it's been an interesting few weeks. So I'm excited to hear your take on what's going on in the market right now. Before we dive into that, I haven't had anybody on the podcast yet that has done student housing. So I'd love to hear more about that investment vehicle and kind of how you approached it and what you looked for.
Yeah, sure. So I guess to kind of put it in context for those, we're starting to invest more into the States now. That's kind of the next step. We purchase a property in Florida, but the reason I bring it up is because Canada kind of writ large is very similar to your more Democrat controlled states in terms of the landlord tenant board regulations and basically the rent control or rent stabilization. So what I mean by that is, for us, we don't really have an alternative to rent control. So one of the ways that student residents actually helps that is what we have is that you can't raise rent on a tenant, even if they are month to month annually, unless you follow the guideline that the government gives you, which it's the guidelines like these days, I think it's 2%. So not a lot, can't raise a lot. However, when a tenant leaves, like some states, you can reset rents to market. Now, for student residents, it's almost always the case that they're in there for 2-3 years. So you can always mark to market your rents. So that's kind of the appeal of the student rental world as it relates to being able to always be market. Now, what, the caveat with that is the student rental business, I don't think it's as bad as some people make it to be in terms of students, causing a bunch of problems with the building systems. A lot of people, my dad included, don't buy students, they'll tear up the place. I think that's a little bit kind of overblown, but it's definitely more hands-on. And I think it just depends on how the buildings are made. Like the stuff in the 80s, 70s, yeah, that stuff's going to take a beating. But most new student developments in the States or Canada, they're built, I always say they're built like prisons, right? They're concrete, they're steel, you're not going to be punching holes in walls. So I think it's a great investment. There's that, like I said in the outset, little bit of differentiation with our market, but I really like it. And I think that if you look at enrollment and you look at specific cities and areas, you can do a good deep dive into what areas have potential. And, you can, anybody that likes numbers, you can get all the information and data that you need.
That's really interesting. We'll have to have you back on the show at some point and do a deep dive into student housing because it's we get those opportunities across our desk every now and then, but we just don't know enough about it. I know, it's kind of like how senior housing is to apartments. Like, yes, it's kind of in the same vein, but in many ways it is not. And there's a lot, you'll have all of your students move out in the summer, right? And so now you've got to find all new tenants at the same time every year. And I know there's ways around that, but that'd be fun to dive into. Today we're going to be talking about Silicon Valley Bank, Signature Bank, these banks collapsing, and to me, what feels like a good economy, right? It doesn't seem like anything. It's not like 2008 where everybody was anticipating something like this to happen. It seemingly came out of nowhere. Um, let's see. Realty Growth is saying, "Hey guys, the weather is getting nicer here in Minnesota, so we are excited." I don't blame you. It has been cold in Nashville for a couple days. I can't believe how cold it is up in Minnesota. We actually just bought a property up in Milwaukee, so um, that's I'm interested to get up there and see that. Apparently, we've got like a foot of snow at the property right now.
Yeah,
But
yeah, we're coming to more balmy weather here too. I think we were like, I don't know, a couple days ago we were in the 30s and now we're in the 50s, so
hey man,
it's getting
that's
warmer
like
for
shorts
us.
weather, right?
Yeah,
For you
pretty much. We're almost
Canadians.
there. You'll start seeing motorcycles out in a couple weeks.
Oh, I've started seeing them here in Nashville, and it's like 40 degrees. I've got a motorcycle, and I am not that hardcore of a rider to where I'm willing to get out in this weather because it just everything freezes. Your hands
Yeah,
freeze, the wind
yeah,
gets through everything. It doesn't matter how many layers you wear.
yeah.
Um,
Agreed.
Dwaraka is asking a very pertinent question. Hi, team. What are your expectations on tomorrow's Fed hike on interest rates? And also, could you please comment on its impact on commercial real estate? So, Jesse, have you been following the potential Fed hikes tomorrow?
Yep. We pretty much kind of we do what you guys do, so we pretty much follow the overnight that the Fed funds rate. Canadians, we pretty much mimic it. I'm sure there's a more sophisticated way to say it, but a lot of times what's happening in the States, we're finding, eventually goes upstream to us. Now, in terms of the actual rate itself, commercial, it really depends. Like if it's multifamily commercial, I assume that your agency debt, which is similar to our kind of CMHC debt, government debt, is predicated on the commercial mortgage bond plus a certain amount of basis points. So like we've been seeing actually since the kind of the banking crisis and everything that's going on in the States, we've seen the actual 5-year and 10 years go down for multi-res. I don't know if that's the same on your end, what you're seeing on the mortgage rate side, but yeah, I've been following it not as closely as I'm sure you guys are, but yeah, I guess tomorrow's the date, right?
Yeah, it'll be interesting to see what happens. I would imagine we're going to have another, 25 to 50 basis point hike, um, which is interesting, right? Because everybody has been anticipating for the last few months that, we peaked a couple months ago, and
Yep.
it seems like maybe with the banking collapse and a couple of other things that, the Fed might be leaning towards being more conservative, which is interesting because I feel like raising those rates may cause banks to default even more. So I don't know. Who knows? I'm not an economist. I can't really make predictions based off of that, but I think it's going to be an interesting couple of weeks for sure.
Mm.
We don't follow multifamily too much. We actually stopped transacting multifamily probably a little over 3 years ago, um, because unless you're CBRE and you're selling the biggest apartment complexes out there, the deals just don't trade. I mean,
Yep.
in Nashville, you could find a 20 unit beater that's already at market rents that you could value add and still not increase the rents that much for a 5.5 cap. And
Yep.
the investors that my team represents typically want more of a value add, and so we just could never find it there. It was miserable. Raphael is saying they might actually freeze the rates because of the banking collapse. That's true. I didn't actually think about that being an option for them to come in and do that, but that would make sense for them to do to take that response as well because they're right now it feels like the Fed's just trying to do damage control. I think that they kind of
Yep.
realized what they did caused some issues, and they're trying to figure it out. I mean, on the Canadian side of the border, are y'all worried about banking collapses in your area?
No. So I'm not going to speak for everybody, but if you look at kind of the history, if anybody's interested, '08, the great financial crisis, part of the reason that the Canadian banks were so successful over that period was based on the fact that we have basically big five, some will say big six banks where we allow branching. And if you're curious to see how the states basically made laws, I believe it was after the Great Depression, that restricted branching in the states to actually have branched banks. So you have, and what branch banking helps with is it makes the risk diffuse. So you can have 17 different branches out of like the same parent company bank. So TD Bank, it can have hundreds of branches. So they're all kind of their own islands. So when one collapses, there isn't that shockwave through the system. This is actually a scenario right now with interest rates where Canada announced on March 10th, I think it was, that we are freezing. So we were holding at, whatever it was for us, 4.5. There's always a delta between the US and Canada, but whatever it was, we held. So if you guys held, it would be kind of the other way around, where you're kind of, keeping in line. And part of the reason for us, this was prior clearly to the, everything that's happening in the States with the banks. But I think our view was that holding it and kind of going steady throughout the rest of the year, maybe a raise here or a kind of a lowering here. I think the idea was that we want to give our business community a little bit more predictability and just the broader community. So yeah, for anyone that's interested to know, that's there was a lot of debate, kind of similar to right now, whether it was going to get raised, whether we're going to hold. So it'll be interesting to see tomorrow what you guys end up doing there.
Yeah, I do want to dig into that because that's interesting that you guys kind of took that different approach towards the banking system. I mean, it does cause a lot of problems when you don't have. I mean, I could see why. There's pros and cons to both. But I mean, to me, it seems like the deregulation of banks a few years ago is really what led to this point. But if you also look at what Silicon Valley Bank had on their balance sheet, and you look what Signature Bank had on their balance sheet, they were I mean, Silicon Valley was incredibly heavy in tech, right? And I
Yeah.
think that, and this goes for commercial real estate investors, if you get heavy in any one sector, at some point it could come back and bite you, right?
Yep.
If you were big in office space or hotels back when the pandemic hit, you could have gotten crushed, right? I mean, everything's fine now for the most part, depending on where you are in the country. But, if you had a diversified portfolio, then, hotel takes a hit. Okay, that's fine. We've got enough cash flow coming from everywhere else. But you have a bank run in the tech sector, and that's the majority of your clients. They're going to pull all of their cash out and leave you kind of in the dust. Ron Rohde is in the chat. Ron, what's going on, man? He was actually on the show a few weeks ago. So yeah, I mean, how are you anticipating, Jesse, that this will or how has it impacted commercial real estate so far, and how do you think it's going to impact it for the rest of 2023?
So definitely what we're seeing on first of all, the brokerage side of things, the deals that are happening are clearly getting, the cap rates are going up still. I think what's challenging is, to your point of, you guys don't do multifamily anymore. Like the whole idea with multifamily is if you can find vacant possession and, bump the rates to market, you're great. Whereas in office and industrial, it's kind of the opposite. Like we're selling buildings where the first thing they're asking is, do you have a tenant? How many, how much term is left on? Because even these developers or REITs that want to hold for a longer term play, maybe a redevelopment into, residential, even they want in place income, even if, down the line, they're really valuing it on buildable foot. So I think from that perspective, we're just seeing definitely different deals happening. I think that the last few months, what's happened over the last few weeks is something that, nobody planned for. But what I can speak for is the last few months, we've found, at least in our area, and we have 83 offices. So, we get a pretty good pulse on what's going on in different markets. What we've seen is a little bit more activity, a little bit more optimism. And then, as this happens, then we get this, this news cycle in the last week or two. So yeah, it's really, it kind of TBD for the next little while.
Yeah, I'm feeling the same way. Commercial real estate's one of those industries where anything new happens and people kind of take a step back, right?
Yeah.
And they try and figure it out, which is funny because some other industries, people just start to double down. And you will see that happen in commercial real estate, but I mean, it happened back in the pandemic, and in April of 2020, I remember we went through, there was that stock market, bear run where it was like Wednesday record lows, Thursday record lows, Friday record lows. And we held through until Friday. And as soon as the Friday stock market just tanked, almost all of our investors terminated their contracts. Well, we stepped back, we waited about a month and a half, and in June, everybody was full force again, buy everything you can, because they're printing money, and commercial real estate's a hard asset. This is going to pan out really well for everybody. And one thing I want to do real quick too, because I always think that this is really interesting. If you don't have a 10B2 calculator on your phone, highly recommend you get one. I use this all the time when I'm underwriting commercial real estate deals. So back when interest rates were 5%, right? I mean, this was basically last year. It wasn't that long ago. If you could afford a $5,000 a month payment, this is on a 240-month amortization, you could afford $757,000 in debt. So basically, you could buy $1 million property if you put 25% down, right? Mm-hmm. With that same payment today, same amortization, let's bump the interest rates to 6.5, which I think is still being relatively conservative. Whoops, messed it up. You can only afford $670,000 in debt. So 1.5% interest changes how much you can afford by $100,000. And that's the kind of impact that interest rates will have on a market. It just takes out the buyers that can what they can afford, really.
Yeah. Which calculator was that? I'll want to take a note.
Yeah, it's on my iPhone. It's just the 10B2 calc.
I think I've heard it before.
So I just come in here. It's got your N is your number of payments, I per year is your interest rate, PV is your principal value, and the payment. It's super, super handy. Because I can go in and just back a napkin, like run some numbers real quick.
For sure. Just picturing university exams, just like, what's the present value of this cash flow stream?
Oh my gosh. Dude, how useless was all of that? Like, how often do you actually use?
What's funny is like, those were the only, the ones that said, hey, bring the calculator. It's like, okay, now that's starting to make sense. It's kind of like, our associate, when I tell him to go try to underwrite something or tell me what he's not, saying, okay, I'll go in a room with half an hour and just a pencil. Like he's using resources around him. If you're interested, I found this article. This is a great article that talked about the FDIC and the difference between Canadians, the Canadian and the origin of the Canadian U.S. bank account. But just briefly, one thing it said, in the United States before FDIC existed, states also had a sort of deposit insurance. These states forbid banks from having branch offices, which was supposed to protect local banks from competition from bigger banks elsewhere. However, this actually made banks more risky since the concentration made it impossible to de-risk vis-a-vis economies of scale. Thus, when the thousands of bank failures happened in the 20s and 30s, those banks that failed were overwhelmingly in the small communities where these anti-branch laws existed. The FDIC was created in reaction to this, but it was a government reaction to terrible government regulations. This is obviously more opining, but it kind of finishes here. We know that a better scenario can happen because it did in Canada. At this time, that US banks were failing by the thousand. There wasn't a single bank failure in Canada because it had only a few banks with thousands of branches. These thousands of branches spread the risk out across economic conditions. And even during the Great Depression, the US banks with numerous branches had little failures. So, I mean, that's Thomas Sowell, if you're interested. He's an economist, but there's been a number of people and historians that have written on this, and just basically the kind of difference where it was funny. It was a regulation to kind of protect banks, and political goals, don't always go the way you think they're going to go. Sometimes the opposite. So yeah, I can send you that link.
There's always some sort of unintended consequence, right? I mean, when you're dealing with 300 plus million people, something bad's going to go wrong at some point.
Yeah, absolutely.
So let's see. Tommy is saying, hey guys, been following you both for a minute. Stoked on this collab. I would love to hear a quick breakdown of some of your guys' favorite or most memorable deals. Jesse, you got one that comes to mind?
Most memorable, like memorable is always easy, but that doesn't mean it's a positive thing. Yeah, I think memorable is really easy. There was a student residence property that I bought that was just outside, in like if you're whatever university or college town you're in, there's like the perimeter of places that students are, and then there's like the town. So you have locals and maybe some of the town's finer people. And what we had, I went to school in Waterloo, which is about an hour and a half west of Toronto, and just outside of the area was basically single family homes that you could get students into, but it was a little bit outside of where students normally normally live. So we went to buy this property. I thought it was going to be a non-headache, and it turned out the people that were living there were basically professional tenants. It was an absolute nightmare to get them out, especially with the laws here. It was threatening lives. We had found kind of suicide notes inside. We had like
Wow.
cops. It was an absolute disaster. And the thing is, once we got them out, we got 6 or 7 students into the space, but it kind of like punched me right in the chin about how much our laws are in favor of tenants and how you really need to put that into the calculus when you're buying these type of properties. And not to mention, like, this is where I was like 22 or 23. So I was doing pretty much all of the kind of renovations that didn't require a license. So, for us going in there, gutting the place, it was just like, holy, whatever. There's a certain way some people live. So we had to pretty much gut everything and re-rent it. And, the positive piece is it turned out to be great. 6 or 7 students years later sold it for a good profit. But it kind of reminds me of, I always tell my partner, if, it'd be, if it was easy, everybody could do it. And I think that's kind of, anytime things are getting really tough in a deal, just think about that, because yes, real estate is great. But there's, a lot of times you're banging your head against a wall, but that's part of the risk and the calculation we make to, I think, have the returns that we can see.
Yeah, we say that in my office probably way too much. I mean, at some point, I'm just going to have to take everybody out and go get that tattooed across our foreheads, because, I mean, at every turn in a deal, something's bad. And we were talking about this earlier today. I was talking with my development team. There's another developer in Nashville, huge developer. He's building skyscrapers, and we're sitting there and we're like, he's dealing with the same stuff. Like, it's not like we're special or that guy's special or this skyscraper developer special. Everybody, no matter how big or successful you are, you're still dealing with the same things in commercial real estate. It just depends on how you get out there and you deal with it, because bad things are going to come up. I mean, so memorable deal for me, and I'll be quick on this one, but it was back in the pandemic. I put an $18 million property under contract to buy, and had no way to pay for it. No way to, like, there was just no chance that I should have been pulling this deal off. Ended up, I didn't have the 1% earnest money to put down on it, which was 180 grand. So I called one of my investors. He put up the money. And then I spent the next 3 months calling private equity firms around the country, trying to get them to do this deal with me. And there were so many points along the way where it was like, oh my gosh, I'm going to lose my investors 180 grand. Plus, at this point I'd racked up like 30 to 50 grand in legal fees, just going through the leases. It was a 330,000 square foot shopping center on 32 acres with 34 tenants, and all the leases had been done over the last 30 years. So some of them were like scanned upside down and missing pages. It was an absolute nightmare. And back to what you were saying, if it was easy, anybody could do it. It literally came down to New Year's Eve, December 31st. I thought that we were going to lose everything. And finally, at like 10 o'clock that night, got a private equity firm to sign on, wire the funds, which obviously would have gone out till the next business day. But, and then we ended up closing, I guess in April that year, and we were able to pull it off. So that was my most memorable deal, because the amount of nights that I spent pacing on the phone, calling everybody whose number I could find. I just felt like it was miserable going through, but I look back on it now, I'm like, hell yeah, I pulled that off. It's a lot of fun.
Yeah, I was gonna say the other one you tattoo right beside that is the we'll sit in the office every day is under promise over deliver, especially on the brokerage end when you're dealing with clients. You're like, don't promise the moon, try to hit your targets, and if you go if you go above that, fantastic. But it's funny, like those ones, to the guy who was asking the question, sorry, I didn't catch the name there, but it goes to the fact that we are much more sensitive to loss than we are to gain, right? When we lose $20 versus gaining $20, it hurts us more. And it's funny because I was the book, oh my God, is it Daniel Kahneman? I'm blanking on the name of it, but he was the first guy to win the Nobel Prize in economics that was a psychologist, a non-economist. And all his like he won that based on his work on loss aversion and how it's in the behavioral economics kind of world, and how we are so much more wired to feel the loss more. And when somebody asks you, what was a memorable deal? Yeah, there's a lot of great deals. I'm sure like you're the same, but the ones that really stick with you are either ones that you lost because there was like pain. You're like, I didn't get that one. Or it's one where there's a lot of stress. Like a couple of years of your life was slowly getting off the life expectancy at every turn of sign back.
Dude, I started getting gray hairs in my beard about a year after that. And I'm like, it was 100% because of that deal. There's just no way.
Yeah, some deals you just know it. This hair is from this deal.
This was from that deal, damn it.
Yeah,
he's got a few books. Was it Thinking Fast and Slow?
Thinking Fast and Slow. That's the one. It? Yeah.
That sounds like a great book. I'll have to check it out. So jumping back into interest rates, I mean, with where they are, I mean, they are unbelievably high compared to a few years ago. I mean, we were getting deals done in the 4s. Now it seems like if you can get something in the high 5s, you're crushing it, which is rare. We're underwriting almost everything at 6.5%. Really, I mean, how do you still think now is a good time to be buying commercial real estate?
I think it's really kind of the vertical dependent, whether it's, you'd look at I always say the food groups and commercial real estate. We talked about this on stage when we were at Bigger Pockets. And I think it's, retail, office, industrial, and multi-res. So putting multi-res aside, I think retail has its specific areas. As the grocery store anchored plazas, the popular plazas people were using over the last 2 years. I think office is, if anybody's interested, if you send me a note on Instagram or on YouTube, or my email is definitely online somewhere, I can send you the top 30 cities, and it's a return to office percentage based on, where were we 2 years ago, a year ago to now. I think the case is starting to get made, but again, it's really you have to really look at the foundation of the asset. So, who are the tenants? What are the terms? Are there demolition clauses? Although I think anytime like we're in right now, the underwriting has to be so much more on point. Like, 5 years ago, people could shoot from the hip and, if they're off a little, whatever. But now with interest rates, like you're saying, I think you have to start really getting more granular. And then kind of the last piece with industrial, I don't know for your market, but we are still blue hot with like industrial. We can't find industrial for people. We were at 1% vacant prior to the craziness that happened in the last 24 months. And I don't know that it's higher now, but we still can't find clients industrial. Like pretty much everything has to be off market because we've seen everything that's on the market. So I think for the outlook, my just personal opinion is that bid ask spread that you're talking about, that's going to have to adjust. And I think we're seeing it, right? We have certain listings that, the owners were like, this is my lowest price. And, we always say, I'm sure you guys do too, there's just deal fatigue, and sellers, some go, no, screw it, I'm taking it off the market. Fine. But some go after 6 months or after a year, they're like, okay, all right. They might have open debt, you pull title, you kind of see what's going on there. And all of a sudden they're like, okay, this is the price. And then all of a sudden that 4.5% or 5% kind of gets adjusted. Right now it's in a weird space where a lot of these prices really haven't gone down and people are trying to hold on to them, but I think it's coming.
Yeah, we've been looking not very seriously because of what they've been asking on the price at an apartment complex here in Nashville that's new. They started off asking $400,000 a door, and it's across the street from another project we're doing. So we kind of looked at it and we're like, okay, well, if we're doing this project, maybe we can just go ahead and get that because it'll cash flow sooner. We could raise capital for both deals at the same time, whatever. But at $400 a door, it's an absolute non-starter for us. That's crazy. And in the last, 6 months, give or take, they've dropped it down to like $330 a door. and we just found out that he has a private money lender on the construction of it that has to be taken out in October. So we're just sitting here and we're like, all right, well, he's going to have to drop it even further in order to find a seller or find a buyer. So let's just wait it out. I mean,
Mhm.
that's the interesting thing, right? I mean, everybody kind of, that's not necessarily in the commercial real estate world the way that you and I are, which is an everyday, this is all we do kind of thing. They
Yeah.
look at it and go, oh, commercial real estate, values must have taken a massive hit. People must be scared of the market, whatever. And it couldn't be further from the truth. I mean, sellers, despite the interest rate hikes, are still sitting for the most part where their pricing has been. You're starting to see some come down, but like in the triple net world, we used to do an immense amount of triple net investment deals across the United States because we have the 1031 exchange. I know
Hmm.
you guys wish you had that too. Um,
Yeah.
but, as soon as interest rates went up, I mean, those are cap rate, interest rate spread plays, right? And so
Yep.
those just disappeared. But for the most part, they're holding onto their numbers. We got a bunch of comments in here. See, Joe and saying, I just started learning about commercial development and I'm learning a lot from your channel, Tyler. Thanks. Absolutely, Jalen. Glad you're enjoying the channel. If you like mine, you're going to love Jesse's, so go check out his channel too. Let's see. Taylor. Hey, Tyler, I can't stay long, but thanks for your channel. Plan to open up a men's resale store and your videos are helping. Appreciate that. That's what we're here for. Jesse and I, when we first got started in the business, there was almost no content out there on commercial real estate. And coming up as a broker, that was absolutely miserable, especially as a younger guy in the business, because, most of these older guys didn't want to help, right? They don't want to create competition. They don't want to spend time on you. And so I always kind of told myself when I was younger, I was like, as soon as I learn enough about this, I'm going to teach people. Ron is saying industrial is great for us in DFW. I love industrial, man. It's the same here in Nashville as it is
Yep.
up there. It's crazy. You just can't
Yeah.
build enough of it. And it seems like, especially this last economic cycle, almost all of the industrial that has been built has been these massive distribution centers. And a lot of
Mhm.
what has been torn down has been a lot of this flex space that has, higher and better uses, multifamily or something like that. So if you can find land, I've been telling everybody this for like 5 years. If you can find land and build flex space, it will lease before you deliver it.
Yeah.
I can't guarantee that, but anecdotally, everyone I've ever talked to, that is the case. Do you guys do much flex space at all?
Yeah, so we'll do like right now we're doing a deal for flex space where it's kind of to us flex is usually that intersection between industrial and office. That's usually what kind of we describe it as, where it's like you could have an office in kind of what really is an industrial facility. Sometimes we call it I class, but just on your point of triple net, one thing that again, when people are saying with this market, why are prices not coming down? It even goes down to the tenant level, right? We've had tenant clients say, what's going on with the pricing? We should see a huge discount. And the reality is there is a discount, but it's not in the net rent necessarily. Like, even though net rents have come down, where we're seeing the big discounts is on the free rent, on the inducement. So, $50 net versus $50 net, but with all of these inducements attached. You get rid of the inducements. For people that aren't in our world, that is not 50 to 50, that's 38 to 50. So even though you can't see the sticker price of the reduction, we are starting to see that kind of delta, because I think that confuses tenants a lot when they're like, wait a minute, this place has been vacant for a year and the rent hasn't changed, or it's changed by a couple bucks per square foot. So I think we are seeing more concessions from landlords, especially on the office side. I mean, those guys have to. That's really kind of the play right now. Turnkey spaces. The idea of telling tenants in this market with so many subleases all over the place to, hey, build out your own space and good luck. Yeah. It's just not happening, right? They're competing with like you and I own an accounting company, and we're like, we just want to get rid of our space. We can't, we don't care what if it's 60-70% recovery, fine. We're obviously a REIT can't do that. They're like, we can't, we want to keep our building values and hit our budgets.
Right. Yeah. I mean, and it's funny. That's one thing that I have to tell, potential investors or tenants all the time. They're looking at these buildings and, well, it's sat vacant for a year. Surely they'll take a deal on it. I'm like, well, no, not really. They don't care. They would rather not lease it up, because if you come in, 50% under their asking rent. Here's how that impacts the value of their building. They would rather just have it sit there vacant than lose all that money. And also, there are banks that will have clauses in the loans that you can't lease it at below a certain price per square foot, which is also something to keep in mind.
Well, on that piece, like the flex office the flex deal that we're doing, it happens to be in their in this company's industrial fund. So they really don't care. They already hit all their targets. So our client is just like, I don't understand. It's vacant. It's like, man, it's not that. It's in a bucket they don't care about.
Yeah. In that bucket, it is less than a drop of water. It does not matter one bit.
Yeah.
Antonio is saying he's a property manager for an industrial REIT in SoCal, and his portfolio, which is over 1 million square feet, is virtually at 100% occupancy. I mean, you just can't build it fast enough. I mean, that's the crazy thing. I mean, I don't know. Let's speculate on that real quick. What do you think is causing that? Right? Because are there really that many logistics, distribution, manufacturing, warehousing companies that have popped up all over North America in the last 10 years? Is it because Amazon has taken, and the bigger guys are taking so much square footage that they're kicking everybody out into other smaller deals? Like, why do you think that's happening, Jesse?
So I was just trying to look up quickly the figure. I think in the States, it's 25 to 30 square feet per person of retail space. Like Europe is much lower. Canada is somewhere in between, but you guys have so much retail space. And even if a fraction of that retail space has gone online, like completely, or, a portion of it has gone online, the backbone of that becomes the industrial stuff. Now in terms of, I think that's one piece of it. And then the other piece of not having enough industrial stock is that supply piece. So you have this demand going up, you've got the supply that's not as robust as it should be to be able to deal with it. And that's where I think a big part of it is. So I think everything kind of hit at the same time, because prior to all these lockdowns and everything, we still, like, anybody that asked, industrial was like 3%, 2%, 1% vacant, depending on the market, some higher than others, but it was still something that we needed to build a lot more of. And I think this coincided with the last 2 years. And all of a sudden you have a scenario where even though other asset classes and what's going on in the economy are being affected, you still have industrial there where people are just like, yeah, we're still looking for it. We'll still pay these large prices.
Yeah.
Yeah. I mean, there you go.
Antonio's jumping back in. No more land, supplies limited. SoCal is not only regional, but bi-national with the Mexican economy. And I think that's it's very true. I mean, you've got a lot of supply that's being torn down for the more, again, higher and better use. All right, I've got to ask about this Charleston White guy, because he's jumped into the chat like 17 times. Congratulations on your pregnancy. Are you pregnant? Jesse, do you have an announcement you want to make?
I guess despite the modern conventional wisdom that guys can get pregnant, no, I am not.
I don't know what's going on. He's asked it like 30.
It's a Russian bot.
It's gotta be. I'm like trying to look this guy up, and I can't find anything on him. Interesting. Anyway, so let's talk about an economic downturn. We've been in an economic downturn, despite nobody wanting to say that, right, for quite some time, because GDP has been, decreasing, and that is technically an economic downturn. How do you think that that's going to impact commercial real estate over the next few? I am blocking him right now. Jay Stunt was like, block him. I'm sure everybody is. Just please get rid of this guy. So, God, he really started going after those questions. So the economic downturn, I mean, do you think that we're going to hit a recessionary, like a deep recessionary environment? I would imagine if we do, we're coming nowhere close to 2008, but be interested to get your thoughts on that.
Yeah, I feel like we're, especially your politics in the States, but I feel like we're in like a 1984 where, once you got into a recession, we like redefined the word recession, and we're like, oh, we're not in a recession because it's no longer 2 consecutive quarters of, negative GDP, whatever.
That makes no sense.
Yeah. I mean, even Janet Yellen, like, you have her saying, well, now, the definition, like, whatever. I think the reality was, if what we have been historically calling a recession, we went through a recession. Now, it was kind of, and a lot of economists have said this, and, pundits, where it was kind of more like a natural disaster that happened to us, right? It wasn't something that was like 08, 09, or 01. I think it was more something that a real shock to the system. Um, I stopped forecasting where I think the economy will be a long time ago. But what I like to ask my guests on my podcast is I'll always say, where do you think we are in a year to 2 years? So like that short-ish kind of view, because at least we can kind of use data that we have today. And, it's always fun to opine on where we are. But I think that generally, and the caveat is we're trying to speak for these huge economies instead of locally. I think what's going to happen is we're going to have a longer cooling off, and not kind of a bubble popping or a crash kind of scenario. I think despite any outside shocks like war or more of these kind of banking issues that are systemic, and that's always the worry, is that it's like 08, 09, where they start bleeding into other areas of the economy. If you remember 08, 09, you couldn't get a loan. Today you can still get debt, fingers crossed, that's still a possibility. But once credit dried up on Main Street, that's when you saw things really start to tumble. But I think we're also due. Like I love the Milton Friedman quote of, the inflation is very much like alcohol. The good effects come on first, the bad effects later. And when you're doing a recovery, the bad effects first and the good effects later. So I think we do need a little bit of this kind of medicine. And hopefully it's not something, we can weather that trough, and then we kind of go back to kind of rebuilding at what I think are kind of normal interest rates. Like if you look historically, 4, 5, 6% interest rates, it kind of makes sense. Like I was just looking at my lease for my car at 0% and just thinking like that didn't seem odd to me when I got that. Now it seems odd that they're like, here's the money. Here's all the money.
Free money.
Yeah. So
I mean, how does that work? It's funny, the first deal that we ever, or I guess my first syndication, our interest rate on that loan was 5.25%. And we were like high-fiving each other in the office. We couldn't believe that we gotten such a good deal. I think it's funny how commercial real estate investors can be sometimes, because the way that you're really supposed to look at commercial real estate is over 10 to 20 years, right? But when you get into such an incredible economy like we've had for the last 10, you start looking at the last 3 months. And that's when you start making mistakes in underwriting. You start making mistakes with your debt. You start thinking the world is always going to be this, rainbows and butterflies. And it just doesn't work out that way. And so, I've always kind of looked at it as like, look, if a percent of interest rate change kills a deal, it probably wasn't a deal to begin with. Would it be nice if, interest rates were lower? Of course, but use that as leverage to negotiate a lower purchase price, or just take the hit and know that, 10 years from now, when you look back on owning that property, you won't be thinking about that interest rate. Hopefully you've refinanced into something much lower, or, maybe even paid it off by then. So, Jesse, kind of diving into that further, what advice would you give for commercial real estate investors in the market today? Considering where the economy is, where interest rates are, what should they be looking out for?
Yeah, I would say you can trade return on equity for cash flow. And what I mean by that is, for a long time, the idea of putting as little down as you could, and so that you could say, hey, these IRRs are amazing, internal rates of return, what we're showing investors is incredible. Whereas the opposite of that is you put a larger down payment and now your return on your equity is lower. So that, you don't have those great, Grant Cardone 40% IRRs or whatever, but you have a very conservatively underwritten property that you can tell your investors that, you're being prudent of how you underwrite deals. And there's always a balance. That's why we don't buy real estate with 100% down. But I think now more than ever is kind of showing people that you don't want to be doing capital calls. They are a part of our business. I mean, I'd be lying if I said that it's not part of what we do. There's a reason that lawyers put it in the partnership agreements and when you're raising outside debt. But you don't want to be going to investors a year down the road and saying we kind of dropped the ball on how much we thought we would need. We need to raise more equity. So I think that's what I would tell them. I'd say when you're underwriting the deal, just be a little bit more conservative. And I wouldn't worry so much about, the the top line returns, I think it's more prudent to underwrite conservative.
Yeah, I mean that kind of goes back to a live stream I did back in January about Matt Onofrio. I'm sure you heard about all of that
Yep.
because he was actually supposed to be there in California with us at the event, speaking at the Bigger Pockets conference. But
Oh, really?
he was his whole thing was, hey, I'm getting 80% from the bank, I'm getting 15% seller carry, and then 5% from an investor. And even before that came crashing down, I was hearing that and going, the amount of risk that is in those deals, those investors probably have no idea. Like, that's a crazy way to set up your
Yeah.
investments. I mean, look, do I wish I could buy every single piece of real estate with zero money in it? 100%. Everybody wishes that they could do that, but there's a balance between responsible investing and aggressive investing. And so now, we won't go into a deal with less than 20% in, because it just, in a downturn, it helps make sure that you can make those payments, or that you can at least catch up. If you have 5% in and all of a sudden your property's underwater by 20%, you've got to come up with 20%. That's a massive hit, and you're probably going to lose that property. So it's just something to keep in mind. Look, I know everybody wants to get aggressive and buy real estate and put no money into it, but
Yeah, I'm always cautious with these. I saw the headlines of like that story. I didn't go too deep into it, but even on I'm sure you do podcasts or interviews where you have your guests, you want to be respectful, but you hear other people's money, OPM, this and that, and it's just like, yeah, well, like there is a kind of an inflection point. You hit a limit where if you underwrite full debt deals, where are you cash flowing? Not to mention the actual risk of the deal, but
yeah.
You're underwriting, and it's not like you're saying, well, we're getting agency debt at this great rate and this long amortization. It's usually a combination of, like you said, seller financing, maybe private debt, and then you kind of stack all those together. That, I don't know. I know that you have states where you cash flow much better. Maybe that's a Canadian artifact where, like, we conservatively underwrite generally, just because we don't have the yields that you can get in some of these like 18-hour cities in the States.
Yeah, I mean, it's you can definitely get as aggressive as you want to in the States, and the nice thing is there's how many different cities that you can invest in that have all different economic drivers and reasons to be investing there. But it's funny that the investors that I've been working with for 5+ years, when they first started out, they were like, I want 11% cap rates. I want to come in here and I want to make a ton of money, increase the value, flip it. Now they're like, no, we want a 7% cap rate. We want it to be stabilized. I don't want to have to deal with all the problems. Because, I mean, that's, again, the pros and cons. 11% cap rates sound very sexy until you figure out what it takes to actually make 11% returns on that property, or what that could imply.
Yeah, there's a reason that as the deal becomes more value add, the GP gets a more outsized promote, right? Because it's not, our industry is not rocket science, but it is this aspect of, as the deals become more laborious, that they need to get a bigger chunk of it.
Yeah, that's exactly right. Jay Stunton is saying, are you seeing an uptick in seller financing in the commercial space? What are you seeing, Jesse?
Yeah, huge. Somebody told me the stat. I'm hesitant to say it just because I like to verify the stats. And I remember we were in a meeting with one of our clients. But if you even, I'm sure a Google search will show, at least from the Canadian context, we've gone up quite a lot. I heard as high as 20% of loans are private / seller financing. All I can say, the anecdata from our own office and offices in North America, we're definitely seeing a lot more of it. We're seeing clients, the way, kind of the bellwether is when you see clients that were absolutely no chance we're doing seller financing, and then they're starting to be open to seller financing, because a lot of them are, again, like we talked about, deal fatigue, where they're just like, whatever it takes to get the deal done. If it means we got to hold a note for a portion, I'm sure it's the same in the States. The benefit to the seller most times is that you can at least defer some of the capital gains. You guys, most of the times, I don't know most, but a lot of times where you can do a 1031, here we have to realize the sale and the tax implication, where seller financing here is, you can, I think, up to 5 years Don't quote me, I'm not a CPA, but I think it's up to 5 years that you can defer that portion of what you're giving back as a VTB.
Yeah, I mean, we're seeing a bunch of seller finance deals right now. I mean, I just seller financed a deal that I sold back in September, and it was right as interest rates were starting to spike. And we locked in an interest rate that I just, one, I can't believe that we got it, but I mean, it was just an incredible deal. It was 7.25% floor, Wall Street
Mm,
Journal Prime plus 150 bips. I think it's like 9% right now. But I mean, they couldn't get bank financing. So
yeah.
we did it.
Hmm.
I'm looking at, I've got another property that we've listed for sale that, I've got it listed for lease or for sale. I don't really care which happens. I'd prefer to keep it, but we'll also sell it if I get my price. And I've got a group that I'm about to actually go meet with as soon as we jump off of this, that has offered to come in, pay off our current note if we sell or finance the rest. And, it's a smaller property. I mean, it's a $725,000 sale. But if we sell or finance it, we're going to make about $250,000 more over the term of the financing. So it's like, yeah, it's
Yeah.
kind of worth doing that. And so if you can explain to sellers how much more money they will make if they just hold the note for you, a lot of them may be interested in it. I feel like, most of the investors that I talk to don't know how to pitch seller financing correctly. And they
Yeah.
make it seem like it's a bad thing when actually for the sellers, it's a pretty damn good deal. Because if you ever default on that note, they just foreclose on you and take that property back.
Yeah, they're like in the Simpsons, yoink. They just
Yeah.
take your building back. Yeah, if it's explained, properly, it's definitely a tool in the tool chest. I think the only apprehension we get with it is if there's current debt. Like it's very easy for these guys that have held assets for longer term, right? And they've realized some gain. But yeah, I think we're going to start seeing a lot more of that, Ty. Like the fact that the oil in the kind of in the joints, or whatever the right analogy is, where you have to come up with these out of the box thinking kind of structures, whereas 5 years ago as a broker, especially like in certain asset classes, all you have to do is put something on the market and you're a genius, where now you have to start rolling up your sleeves.
Yeah, that's exactly right. Ali Raz is asking what happens to the down payment. I'm assuming you're saying in the situation where you foreclose, it's gone, right? I mean, if you get the seller to seller finance the deal, you put a down payment down and you default on that note, it's just like if you defaulted with a normal bank, right? They're going to take the whole property back and you get nothing. But I mean, you can structure it in a way that works better for you and the seller than you could traditionally with a commercial bank, because they'll be a lot more flexible. There's more benefits for them to do that. So there's a lot of reasons for it.
Do you guys see, like, a lot of times when we do seller financing, we do say a bank in first position and then seller financing in second position. So it's kind of a hybrid. They get debt from the bank, but they might ask the vendor to like top up.
Yeah, we'll see that occasionally. I mean, most banks don't really like that because
Hmm.
they don't want any other mortgages to be on the property. Even though they're in first position, that's fine, right?
Yeah.
But it also depends on what kind of loan it is, right?
Hmm.
Like, with the building that I sold in Chattanooga last year that we seller financed, um, the bank that they were trying to refinance us out with they were going to do a construction loan. So they couldn't refinance us out. Then they wanted us to take second position as the debt on the property so that the person giving them money for the construction could take first position. And we said, absolutely not would we ever do that. Makes zero sense. So yeah, I mean, you'll see it occasionally. I mean, typically, like, one other creative way that I've seen it structured is give the seller preferred equity in your deal, right? I mean, you
Yeah.
could treat it as preferred equity instead of debt and have them carry that. Michael's asking, is it a good idea for a small business to build in town or build a shop on our own property?
On our own I mean, if you own the land already, I feel like half the work is done for you there.
Yeah.
If that's like it, if you can do it and it's not a zoning, like, it's all going to be dependent on where you are and what the costs are. Like, the reason I bring that up is, like, again, certain states and certain areas in Canada where it's just the development charges for us become such a huge part of development that it's just worth it to go find something that's existing. But if it's a long-term real estate play, it sounds like you're a user. So you're building residential property, no zoning issues. And sorry, what's the type of business?
Well, it seems to me, I mean, most places have, if it's residential zoning, they won't allow a business. But maybe it's a mixed use zoning
Yeah, because
currently.
what I was gonna say is, like, if you are an owner operator, you have a little bit more flexibility. You're kind of a uh, real estate play wrapped in an operating company. Yeah, manufacturing. So, like, for us, like, usually when we have industrial or office and we have a user that's buying it, they're the ones that are going to be able to pay the highest price for it because they can take a longer term view of it, and usually they're leasing to themselves anyways. But yeah, really would have to be deal specific. If you have something where you can kind of compare apples to apples versus, that's usually what we end up doing. We do kind of an analysis side by side.
Yeah, I mean, I would say pretty much the same thing. I think if you've already got some land, really it depends on your goals, right? Is this a spot where customers are going to be stopping in all the time, or is it a spot where you guys just need to manufacture and you've got like outside sales reps that are closing deals? If you've got outside sales reps that are doing it, I would get as far out of town as possible as what feasibly makes sense for you guys. Get it as cheap as possible, and go from there. But if you need people stopping in, then you've got to have the foot traffic that retail will bring.
Yeah.
It makes sense, very helpful. Need to factor in the exit plan. Doesn't need retail foot traffic. Yeah, I mean, Michael, I would go for it's all e-commerce. I would go for something that's definitely cheaper, maybe on the outskirts of town. If you've got the property already, sounds like you're good to go. Jesse, thanks for coming on the show, man. Appreciate you diving in. This was a great conversation. Really interesting to gather your thoughts on where commercial real estate is headed in 2023. If anyone listening on the podcast or watching here on YouTube wants to follow you and learn more about what you're doing, where can they find you?
Yeah, you can Instagram Jesse Fragale, YouTube Jesse Fragale, Fragale, and really, I always say on the podcast, a Google search will probably pull up hopefully positive things. And yeah, no, I appreciate you having me on, Tyler. You that was great, and yeah, keep on strumming that guitar over there.
Yeah, man, we'll have to jam out sometime.
Deal.
See you guys. Thank you for listening to the Commercial Real Estate Investor Podcast, brought to you by Hamilton, your resource for passive real estate investment opportunities. Visit www.investwithhamilton.com to start building your passive real estate portfolio today.